ETF. It's been wildly successful. James Seafart, he's an analyst at Bloomberg. He's been doing an incredible job.
Why do you think miners are selling?
If you said to somebody in traditional finance that, the price is up 130% or something, they would say, well, yeah, that's obviously a bull market. Crypto's different. We want 10Xs.
Asset management businesses are also very competitive businesses.
If we end up with an Ethereum ETF,
look at that.
This is the number. We've already had 1, 2, 3. What is the rule that you've always come up
with? The BCG rule of 3 or 4. We go back to the basics of the blockchain trilemma problem.
The network has inflation of about 6%. And then if you're a staker, you're capturing that.
That's an important insight.
The next wave of users that come into crypto are going to be non-crypto natives. A new feature in Token Terminal, this is blockchain comparison.
Welcome everyone to another episode of The Rundown with Shiv and Michael. Today we got another power-packed episode like last time. I really enjoyed last week's episode. I hope you all enjoyed it as well. It was our first episode that was 1 hour long and we got really great feedback about it. And I've got Michael again, and I know that he's been so active, talking, posting so many things, nerding out on on-chain data like always. So Michael, what have you been working on in the last 1 week?
Huge nerd over here. Hand up on that. Yeah, it's good to see you. Nice to be back. Episode 14 of The Rundown today. Yeah, a lot going on. I mean, the markets have been up, which is nice to see. I think there's a lot going on with these ETFs, which we're going to talk about a little bit more again today. Working on a lot of stuff. There's a lot going on with the DeFi report. We're building a new website. So we got a lot of things happening behind the scenes. Working on a report on Tron. For people that are unaware, Tron has turned into like the #1 blockchain for stablecoins and Tether transactions. So this Tron research is almost turning into a research report on Tether. So we'll have some interesting insights coming out for readers of the DeFi report as well, related to Tron and then stablecoins. But yeah, excited to get into it today. I think we got a lot to talk about with just Bitcoin ETF. We've been crunching some numbers, which we want to share with everybody. And then we're going to talk a little bit about Ethereum versus Solana, just sort of high level current thinking on those two. And then we'll hop on chain and we'll do like a little exercise on how to kind of spot a trend using on-chain data with Token Terminal, and then kind of how to go deeper and like tie that all the way back to like actionable insights. Yeah, excited to jump in.
Amazing. Before we jump into the serious stuff and the educational stuff, I want to start off by seeing what the American president is doing on Twitter with his laser eyes. What is that?
Yeah, I don't know. This is the first time we've seen the laser eyes from President Biden. So people may have seen this earlier in the week. This was, I think, on Monday. This came up, or it was after the Super Bowl. Joe Biden just tweeting out the laser eyes. We haven't seen this. We've seen it from other, we saw it from Tom Brady at one point. We've seen it from other celebrities. We haven't seen it from the standing president just yet, but I don't know. Shiv, have you looked into this? Did an intern? Do we have a rogue intern? Is this just something else unrelated to Bitcoin?
Look,
do we know what this is?
I just think that we are living in a simulation now, and there is a glitch in the matrix.
I think that's it. We could probably leave it at that. Interesting nonetheless. I guess it's bullish.
On a
Bitcoin,
serious note, and because you're the data person, on-chain person, when this got uploaded, did we see a spike in Bitcoin, even if it was for a few minutes, or no impact on the Bitcoin price? I know we're going to now move to the Bitcoin price action, which has now breached $50,000, which is amazing for the community. But did this tweet had any role with that?
I don't know. I'm not following this stuff on a minute by minute basis. Maybe it did. I think that what I've been looking at more is sort of the ETF flows, and maybe we can just talk a little bit about ETF flows. So I've got some data just from the block here. This is just showing the inflows, which are above this 0 line here, inflows. And then these outflows are coming from GBTC. So GBTC is the existing Grayscale Bitcoin trust that was converted to an ETF that had a 2% management fee. When they converted to the ETF, it went down to a 1.5% management fee, which is still orders of magnitude higher than just about every other ETF out there. So people are trying to get out of this ETF, and that's what these outflows are. Now, those are being offset by inflows into BlackRock and Fidelity and VanEck and Bitwise's ETF. What's been interesting here is you can see that when the Grayscale Trust was initially converted, there were quite a few outflows on a daily basis. And you can see that tailing off. And at the same time, you're seeing like more inflow, at least this was last Friday, more inflows coming into the ETF. I was just crunching a little bit of numbers in terms of like the average Bitcoin that's being gobbled up by this thing. And I'll switch my screen here. So James, if people that aren't following this, James Seafart, he's an analyst at Bloomberg. He's been doing an incredible job basically updating the flows on a daily basis. This is the last one I think he tweeted out. This was from last Thursday, and it shows the net. I'm focused on this column here because it has the Bitcoin that's moved out of grayscale, which we need to count that. I saw a well-known person on CNBC yesterday who did not count that and was basically saying that the ETF is purchasing 12 times the number of new Bitcoin coming into the market. I think that's a little disingenuous if you don't count the outflows here. This was as of last week, so this has gone up a little bit since, but we had $2.2 billion of assets under management. That's the net flow. The BlackRock ETF already has 3.4 billion in it. Almost 3.5 billion. What I did was I just took this number, this 2.2 billion, took the Bitcoin price at the end of February 8th and divided that to get to the total number of Bitcoin that have been purchased by the ETF since inception, and then divided that by the number of trading days to date to get a like average of like how many Bitcoin is the ETF buying per day. And it came out to over 2,100 Bitcoin per day. We know that Bitcoin's monetary policy is very straightforward, predictable. So there's only 900 Bitcoin that are issued per day. That's kind of an interesting data point that just on average, where, it's like 2.4x just the daily issuance is being bought up by the ETF. So pretty bullish. I was looking at some other on-chain data related to long-term holders and what they're doing. So like 70% of the Bitcoin hasn't moved in over a year still. So that's another interesting data point just from kind of Bitcoin's smart money. And then we were also looking at some miner activity, and the miners have been selling pretty aggressively, actually kind of interesting, selling pretty aggressively into this recent rally over the last few months. So that's another interesting data point that they've been selling aggressively and the price has been rising. So it just gives you an idea of how many buyers are out there, and we're still not really in that like bull market period just yet. We can tell by like just kind of looking at sentiment, and this is just Bitcoin, Google searches, still it's at a level 12 right now. At the peak of the last cycle it was up around 53, it got up to 100 back in 2017. So we are still, I think, very early in this cycle if we are going into a bull market, which I think we are. Any thoughts just from your perspective on just the ETF? It's been wildly successful. I think the flows have just been, just wildly successful compared to like your average ETF, of course.
Yeah, look, I totally agree. I'm just quickly want to touch upon the statistics that you suggested that miners are aggressively selling. So I recall that when we did the end of year 2023 Bitcoin health check, which we both did on the rundown a few episodes ago, people should definitely check that out. We were early at that time telling people that the fundamentals of Bitcoin are strong. We would be expecting this. At that time, from what I recall, when you shared the statistics, miners were actually holding. So miners were actually holding at that time. So now they're aggressively selling. I'm curious to get your take, since you are really, deep trenched onto the data and you've seen the statistics, and you probably would have asked this question to yourself as well. Considering that we are saying that we're still very early. And I also agree that I don't think the bull market has started yet, precisely for the sentiment reason, because, fundamentals help us to gauge whether something is undervalued, fairly valued, or overvalued from fundamental indicators. But at the end of the day, it's the sentiments that prop up the price action. That's my belief, and that's my theory. So why do you think miners are selling, aggressively selling, considering we haven't even started the bull market?
Yeah, I mean, hard to say. We've seen other periods where they're selling aggressively. They were selling aggressively towards the end of 2022, and the Bitcoin price was capitulating. It was sort of like we were finding a bottom in the market at the time. And this time they're selling almost at a similar rate, but it's into really strength in the market. Hard to say. I mean, it could just be that there's operating expenses that need to be paid. Some of the large miners may have, they order ASIC machines in bulk and we finance that stuff, and like you just don't know what, like maybe there's a couple of them that just had some large payments on operating costs or build outs or whatever, and they needed to sell. So it could just be an operating, just managing your treasury and that type of thing, and managing your internal finances.
Would it be fair to say that one of the takeaway from at least this particular anomaly is that, because I've done this, so I'll speak for myself, a lot of times I look at that statistics and am like, this is an indicator to showcase that we're going to start entering a bull market. And if they are selling, then like that's one of the indicators that I use. Would it be fair thing to say that if anybody watching out there just use that statistic by itself to gauge future price movements, that is a flawed strategy and that should be used along with other indicators as well?
Yeah, exactly. 100%. I would say always looking at lots of indicators and not just one. I don't think there's certainly some indicators that we value, more than others and put more weight on than others. But in general, like, yeah, if you're just looking at one or two things, like there's lots of different anomalies in the market that can cause you to get head faked. So yeah, I wouldn't read too much into it. The way I'm reading into it is it just sort of shows the strength, I guess, of the market currently. I tend to think we are in a bull market. So I would say we are in a bull market, but it's not the bull markets in crypto. It's weird how people put this term out. If you said to somebody in traditional finance that, the price is up 130% or something, they would say, well, yeah, that's obviously a bull market. Crypto's different. We want 10Xs and, so the market's a little different. I think we are in the bull market, but we're not in the frenzy, certainly not in like what we've seen in the past in terms of hype and narratives and just, media coverage and all that.
So, I've got a challenge for you, Michael. And I'm putting this on the spot. This is whatever we do on the rundown, by the way, it's never scripted. Michael shows up with his data and I just ask him questions and I see everything over there. So that's the beauty of our podcast. Everything is unscripted over here. So I got a challenge for you, Michael. I want DeFi Report and Michael Nadeau to create a framework that's, showcases what indicators, like the weightage of indicators according to you for Bitcoin.
I think that would be really interesting to put something together there. And another exercise I've been thinking about going through as we head into what I think is the next cycle here, because of also the macro setup, which, we could talk about as well. But you see these things in the market, like last cycle, you had DeFi summer in the early 2020, summer of 2020. And then after that, we had Michael Saylor, Paul Tudor Jones, and then you had Mass Mutual purchase Bitcoin, you had Square purchase Bitcoin, you had Tesla purchase Bitcoin, and then Michael Saylor just became, kept buying Bitcoin, and then we had El Salvador buy Bitcoin. So you had like these these stair steps of like bigger and bigger players coming into the market. And I think one way to sort of forecast where you think the price could go is to start to think about these types of things for this cycle. Like, what is it? Is it corporate adoption this cycle? Is it more central banks purchasing Bitcoin? Is it just the ETFs and the fact that they're like an institutional asset and they're being, put into, portfolios? We can talk about Fidelity's started to allocate 1% to 3% most of their portfolios. So you can start to forecast out like price targets, and then what are the things that need to happen to sort of get there. And that's another like exercise. These are the types of exercises you have to go through with something like Bitcoin, because it's just a different type of asset. It's not a discount cash flow type of analysis.
Amazing. Do you want to show that statistics? Because even I noticed that Fidelity asset allocation, and I know that you wrote a LinkedIn post about it as well.
Yeah, this was just me sharing, like, it was interesting to see. And I saw a few other people on Twitter had this out there of just showing what Fidelity's doing with their allocation. This was a conservative ETF that they have. They're putting 1% Bitcoin. Bitcoin has been proven with back testing to just provide superior risk-adjusted returns at, basically up to like 5%. Obviously, you have to stomach the volatility once you start going past 5%. But, this is interesting. If this starts to get normalized, that's a constant bid on Bitcoin in the market, just like the S&P 500 has a constant bid on it from 401ks, and everyone's just constantly buying the asset in bear markets, bull markets. And it could potentially dampen Bitcoin's volatility over like a long enough period of time. I think in the short run, it's probably not, but just having that constant buyer, I think could dampen the volatility a little bit over time. And like the other interesting piece about this that I mentioned is just like, I guarantee you Fidelity's never added an investment product to a fund and then had people all over the world talking about it as like a free organic marketing campaign. So that's just pretty interesting. So nice little stuff up.
It's like what we said, I think it's a long time back. I do not know whether it was on the rundown or whether it was on the Proof of Work podcast. But I recall the statement that I made. BlackRock came to Bitcoin rather than Bitcoin coming to BlackRock. It's exactly the same. I think asset management businesses, at the end of the day, people don't realize it, but asset management businesses are also very competitive businesses where, yes, they have high margins, but they spend a lot of money on marketing, on distribution as well. And when you add an asset like Bitcoin, they get a lot of free marketing, which they wouldn't get if they add, let's say, Meta or Snapchat. So yeah,
pretty interesting. And we'll see, but let's see if we end up with an Ethereum ETF.
look at that.
This is the number. We've already had 1, 2, 3, 4, 5, 6, 7, 8 requests for an Ethereum ETF now. So the next deadline is March 10th. That's for the BlackRock, and that's the second deadline. So there's 4 deadlines for all of these, and the final deadline for the Van Eck Ethereum ETF is in May. So people are pointing to May as potentially when Ethereum gets approved for an ETF. That's 3 months away. So this is pretty interesting. I mean, we'll see. We'll see if there's some other excuse that we see coming from the SEC, similar to what happened with Bitcoin. Now that Bitcoin's been approved and Ethereum has a futures market, which is really the argument that the court was making with Bitcoin, that if you have a futures market, there's no reason why there's not a spot market. So it's going to be hard, I think, for them to come up with something. Maybe it's a liquidity issue or something else. We'll see. But this is pretty interesting because Ethereum has that monetary policy where they're burning a lot of the tokens and stuff. We haven't seen what that looks like in a bull market in terms of reflexivity in the market. So something to keep an eye on. I know a lot of people have been talking about Solana, and we're going to get into that, but I think Ethereum is going to have its moment later on in this.
So just quickly, so the few questions I've got. Spot Ethereum ETF, the asset manager is going to hold like Ethereum, no derivatives, but actual Ethereum. What are they going to do with the staking reward? Is that going to come in the form of dividends to the actual ETF issuing company, the asset management company, or the holders of, let's say, Van Eck Ethereum ETF? Like, how is that going to work according to you? I know it's speculation.
I think it depends on what gets approved. If this does get approved, I can tell you that there is a regulated product coming out in Europe, and that's going to trade, I think, on the Swiss exchange and also on the major German exchange.
And that's the spot Ethereum ETF.
The spot Ethereum ETF, and that is reinvesting the dividends automatically. So that's how that one's going to work. It's not necessarily paying out the staking rewards, but it's like a dividend. It's like owning a dividend stock that just automatically reinvests it. That's how that one's going to work. I'm not sure how this will work. A US-based spot ETF, you could imagine if this is rolled out and they're not allowed to share the rewards, that would be extremely profitable for the issuer of this that's capturing those staking rewards on the back end by staking. So
just quickly, since you are the LinkedIn top voice of crypto, and we have the honor to have you every week on the rundown as well, what do you think? What are the chances of a spot ETF for Ethereum, approved in the US by May? What do you think? What are the chances?
So I think I've seen Bloomberg come out and give it about a 60%. I'm going to rely on, I'm kind of like, since they were correct on the Bitcoin one, they're giving it, I think, a 60%. So you're giving it a higher probability of going through than not. So that's something. I do think that politics are messy over here, and we'll see. Like, I sort of expect that the SEC will come up with something and try to delay this a little bit more. I think it's inevitable, but I think they would love to buy as much time on a lot of this stuff. And I think they're worried about sort of fueling a bull market, right? Like if it gets approved and it's happening and the market's going up. So we'll see. Sometimes the success of crypto can be its worst enemy. If you get into a hyped frenzy period and they're about to approve an Ethereum ETF, I'm a little cautious, but I think it's definitely inevitable. I think.
Well said. Well said. I'm in agreement with you.
So why don't we talk a little bit about Ethereum versus Solana? I think that was something we wanted to get into, and then we're going to go on chain a little bit later. But, I've been put out the Ethereum investment framework. I think a lot of people have had questions for me on Solana. Like, do I have this view that Ethereum is sort of has some runaway network effects? And it's just, that's my view, but it's really not. So we've covered Solana in the past through the DeFi report. We covered it during its worst moment when FTX was going down, and we wrote at the time that we expected the ecosystem to come back. That turned out to be a pretty good call. And the reason for that was we saw a lot of the same traits within Solana that if you look at Ethereum back in 2018 or so, you could see that Solana had a lot of the similar characteristics in terms of it. And this is just, it's kind of intangibles. It's hard to sort of like put your finger on a lot of these things, but it's really just the developer community, this like mission driven sort of like, there was like this religious fervor coming from the developer community. A lot of people were sticking around and fighting when some developers were leaving the ecosystem. You could see that it was being battle tested, and it was developing just that character that you kind of need to develop, I think, to like make it. And so I've sort of been bullish on Solana for a while. And my view is that we are going to have sort of pull up some of these different traits. So I want to just go through really high level. I don't want to get too technical here, but just go through sort of how I'm thinking about Ethereum versus Solana heading into this next cycle. My view is that we should see a small handful of major layer one blockchains. And the reason I think it's going to be a small handful, and there'll probably be a longer tail of less important ones, is just the power laws that we've seen already on public blockchains is sort of one reason. And then when you look at past computing movements, such as, mobile phones or cloud computing or software or even like infrastructure, there tends to always be a small handful of major winners. We've talked about this. What is the rule that you've always come up
with? The BCG rule of 3 or 4, that after a certain stage of maturation of an industry, it's either 3 players or 4 players.
So you get this consolidation. And so that's part of the reason why we're talking about Ethereum and Solana. My view is that Bitcoin has already achieved this sort of status as like internet money, and it's kind of off to the side. It's digital gold. There's going to be a competition now for like this smart contract layer one. And I think there's going to be a few of them, and they're going to have slightly different computing architectures that ultimately service slightly different use cases. And they can both be very successful and win at the same time. They're competing against each other, but you could have multiple winners, just like you have Amazon and Microsoft. So the main differences here, I think, for people to think about is really the tech stack architecture. So Solana is being built out in like a monolithic setup. And what that just means is like the settlement and the execution services are all packaged together into the L1. And that's the approach to scaling. Ethereum is taking this modular approach where you're separating out like the elements of the tech stack. And I'll just pull up a visual here. So this is the tech stack for Ethereum. And we can see this is like the modular. This is kind of a simplified view of it, but you have like wallets at the top of the tech stack, and that's where users are. And users are connecting their wallets to web interfaces to access services. Underneath the hood, you may be interacting with like an aggregator that's actually like, pulling liquidity from a bunch of different decentralized exchanges or something underneath there, or whatever. It's interacting with a number of different protocols underneath. And then you have the protocol and application layer. This layer is being serviced by the execution layer underneath it, which is just allowing protocols and apps to access, higher throughput, basically more bandwidth, cheaper fees. We've seen like now this new layer in Ethereum, data availability, because the cost of these L2s to anchor all the proofs of all the transactions to Ethereum is pretty high. And so they are solving a problem in here. So each layer of the tech stack has economics and has a margin and has a business model to it. And that's sort of how Ethereum works. Solana is essentially just this base layer, right? It doesn't have layer 2. It doesn't have data availability. Not right now. Like I think it actually probably is going to need these extra layers. It was launched earlier than Ethereum, so it's less mature. But right now it's just layer 1 settlement. So you have the apps sitting on top of this, and the execution and the settlement happens, and the data availability and the consensus all happens on the layer 1. So I'll pause right there. We can talk about what this sort of means for users and developers and where it goes from there.
Yeah. So just quickly, what you're saying is that in Solana, we've got everything like what it is shown over here, except layer 2 execution and data availability layer.
So on Solana, I probably should have create a separate visual for it, but you wouldn't have all these layers on top. You would just have the wallets sitting on top. You have the wallets sitting here on the data availability layer, and then you have apps and aggregators underneath it, but you don't have the layer 2 execution. Is that what you said?
Yeah, that's what I said. Yeah.
Okay. Yeah. So you don't have the layer 2 execution. You basically bundled the layer 2 with layer 1, essentially.
Got it. Yeah. And just quickly on it, because I'm academic, and as part of teaching MBA students in India, about introduction to blockchain or crypto entrepreneurship, I still teach them FAT protocol thesis. So I'm getting a little bit academic over here. And I want this takeaway from you before we move on to the next section, which is, what is your thoughts about FAT protocol thesis? Do you still believe that the majority of the value would be on the layer 1 settlement? Or do you think that eventually, whether it's Ethereum or Solana, because that ecosystem will mature as well eventually, do you see values being accumulated on other layers and not just layer 1?
So yeah, for people that are curious about this fat protocol thesis that Shiv's mentioning, this is the idea that value in Web 2 accrued to like the application layer. So you had this like thin protocol layer that's like TCP/IP and SMTP, which is simple mail transfer protocol. You have all these protocols that the behemoths of Facebook and Google and Microsoft, they built their consumer applications on top of that. And that's where all the value. Nothing went to the protocols. This was funded by government grants, and there was no business model here at all. And the thesis is that in Web3, this flips. And so you have these open protocols, and this is actually where the network effect is, because if you think about like SMTP, Google and Microsoft are tapping into that protocol. That's actually where the network is. That's what's connecting everybody. And because, Microsoft Outlook is tapping into the same protocol that Gmail is tapping into, they're naturally interoperable. So those network effects are really strong. So the idea is that, something like Ethereum and the protocols on top of it, this is the connective tissue. This is really where the network effect is in Web3. The applications are just tapping into that to access that connectivity. And the difference in Web3 is that we've developed a way to monetize the protocols, and we do that with tokens. To answer the question on, do I see this continuing? So this has been true to date. I don't think anybody could even argue whether this is accurate or not. This was a thesis that Joel Monegro from Placeholder put out, I think 2016, like a pretty long time ago. It's been accurate. If you look at the market caps of the top projects in crypto, they're like the layer ones. They're the base protocols. I don't see why this is going to change. I think so moving forward. So if you forecast it out like 5 years or so, do I think Ethereum and Bitcoin are still going to be like the largest assets? And I do. Now, that doesn't mean that there aren't going to be more returns on the applications going forward, right? So because Bitcoin's already $1 trillion asset, it could go to 5 trillion or something, but that's a 4x versus if you invest in an application, you could get much higher returns. But the most value in terms of market cap, I think in terms of total value locked, those types of metrics, I do think this will persist moving forward.
Understood.
That's the question.
Yeah. So would it be fair to say that, let's say that the decentralized applications built on Ethereum, based on this, because I also believe in the fat protocol thesis, and I have few people who actually came on the podcast, Proof of Work podcast, who argued with me that they think this will not be true eventually. So I have seen few critics of it, and we can get them on the rundown sometimes to argue with us as well. We can probably do that. But just quickly on that, I think what you are saying, and I also subscribe to that thought, but just as a key takeaway for the audience, and tell me whether I'm on the right track. What we are saying is that we will probably never see a decentralized application that is built on Ethereum have a market cap higher than Ethereum.
That's my thinking. It's possible. It is possible. Like, I think you have to be open to the fact that we could be wrong about that something, because when you look at I can just pull up real quick here. This is the total monthly users in crypto right now, and it's around 65 million monthly active users. If you looked at Ethereum, it's probably somewhere around 10 million monthly active users or so. The point that I'm trying to make, and this is another view here, these are like daily users, so 1.2 million is the most of any network. The point I'm making is, like, let's say some game became wildly popular, or social media app became wildly popular on Solana or something, and it got 100 million users. Should that be a higher market cap than Solana? I don't know. I don't think it's going to happen where it's going to flip the protocol itself, but I think it's worthwhile, like, being open-minded to, like, this. We're still early here, and like, we could be wrong. We could be wrong.
Yeah, I agree. It could be possible that fat protocol thesis eventually may not hold true, but for the time being, at this stage of crypto, it is holding true.
And it makes sense to me why it is holding true. When you think of, we've talked about like GDP. So in my mind, if Solana has, hundreds or thousands, or Ethereum has hundreds or thousands of apps built on top of it, and it's powering all of that with its infrastructure, with its consensus mechanism, with all of its standards, then it makes sense to me that actually is more valuable than just the app that's built on top of it, that's leveraging all of that. So anyways, that's sort of the, I guess, the tech stack architecture. I think you could argue that Solana may end up in a modular format at some point here, but I think this is the main sort of difference today, is the approach towards scalability. So Solana has focused on scalability first, and Ethereum has focused on decentralization first. And really what that comes down to is like the hardware requirements to run a full node, which stores all of the transactions of the blockchain. This is like the most important thing with, why are we here? Like, the network has to be decentralized. The access to the data has to be decentralized. It has to be permissionless. Developers need to be able to build anything that they want. Users need to be able to access these networks with no permission needed and do it in a peer-to-peer manner. And to do that, the data has to be decentralized, right? So that not one single entity can control access to that data. And so the hardware requirements are what Ethereum focused on initially. They made it really easy for anybody to run a full node. You can do it, I think, you have these specs, you can run the node. You probably wouldn't want to run a full node on your working computer, but you can do it, and it costs a couple $100 to spin it up. It's pretty easy. The complexity to set that up, the cost to set it up is lower than Solana. But of course, the trade-off to that is that it's not very scalable, right? So you made it really decentralized, but the trade-off is that it's not super scalable and it has to scale in that modular format, whereas Solana made it really, the hardware requirements are much more difficult with Solana. So it's more costly and it's more complex to set up a node, but it can propagate a lot more data. It's just a much, in terms of just physical constraints and from a physics perspective, how much data can be propagated on Solana, it's much more. Whereas Ethereum is going to try to do this at the layer 2 and the data availability layer to expand those physics. I think the main difference, and when you think about that, it actually factors into the go-to-market strategy where Solana has optimized for scalability, and in doing so, the transaction fees are extremely cheap, which means the network is not profitable today. And it was the opposite with Ethereum. Ethereum focused on decentralization. The transaction fees are very high, and that has made Ethereum profitable much earlier on. And now Ethereum is trying to solve scalability. If Solana is successful with solving scalability first, they could potentially have pricing power later if they get to those really strong network effects. So they get pricing power later. And if that happens, more people will want to run validators. So this number, the number of nodes, which is also validators, this number will go up, because it'll become more profitable to validate the network and run and to invest in the more complex setup. So it'll actually become more decentralized over time if successful. So it's just they're just coming at it from different ways to achieve the same thing, really. These are sort of we sort of divide the lines on the differences. But is there any questions you have on just anything in terms of the features here?
Yeah. So before I do have questions, and before I get into the question, quickly making another academic comment, which I think you would appreciate as well. And you are obviously familiar with it. But since we spoke about FAT protocol thesis, and when we're discussing about decentralization, Solana taking the opposite approach, which is being scalable, we go back to the basics of the blockchain trilemma problem, right? Of the old school computer science problem of a blockchain trilemma, where only two sides of the triangle can be solved at a time. That computer science problem haven't still been solved. And that's why when somebody comes up and says that they can do 100,000 transactions per second and they are more decentralized than anything else, I'm like, please go back to the basics, see the blockchain trilemma problem. That hasn't been solved. If that has been solved, they deserve an award for computing, Alan Turing Award for that, because nobody has solved that. So going back to the blockchain trilemma problem, two sides of the triangle can only be solved. And the three sides of the triangle are security, decentralization, or scalability. Everybody wants a secure platform. So that is a given that whatever blockchain platform will be used, it will always be secure. So now you got the choice, whether you want to be decentralized or you want to be scaled. Bitcoin, 7 transactions per second. Why? Because it is the most decentralized blockchain in the world. Then comes Ethereum. It's again because they have chosen decentralization over scalability, and now they have positioned themselves from proof of work to proof of stake. So again, Solana, as we can see from this amazing DeFi report comparison, 2,919 nodes compared to 6,138 nodes over there. The number of validator clients required, Ethereum 6, Solana 1. It's clear over here by the statistics and what Michael alluded to as well. Ethereum focused on building a decentralized virtual machine, where Solana focused that if they want to beat Ethereum, they need to firstly be scalable, get the people, and then eventually work on the pathway of decentralization. And I think that's a very good business strategy as well to differentiate. All that I'm saying is that when people go out there and say that Solana is more decentralized than Ethereum, or that it's more decentralized than any other blockchain out there, look at the statistics, go to the basics of the blockchain trilemma problem, and question all that before you start shilling and believing things without doing the research.
Yeah, no, well said. I think there's a lot of discussion out there. You go on crypto Twitter, you'll see these debates, and it's just never ending. It's fascinating watching developers debate these things, and it's almost like religion, but you do see a lot of discussion about how Solana is centralized. And I think important to recognize that every single one of these networks has been centralized at the beginning. Like, it's impossible to just drop a blockchain network out of the sky and it's decentralized. These things have human interaction, and even Bitcoin Satoshi was the only person mining Bitcoin at one point. If they're successful, then they become decentralized. And I would say Solana, I don't know what the proper thresholds is, but I think they are properly, sufficiently decentralized at this point. So, when it comes down to, you mentioned like these validator clients down here, this is a big deal for Solana. So they have had issues because they only have one validator client, that if there's an issue with that validator client, the network actually goes down.
Which it does often.
It went down recently.
Yeah.
Yeah. And so it was down for 4 or 5 hours just a week or two ago. This should not be happening. And they are going to be rolling out a new client called Fire Dancer that is getting a ton of hype. It's developed by Jump, which is, a market maker, pretty powerful player in the space. And that should really help just the uptime of the network moving forward. Ethereum has a number of different clients. So if one goes down, the network doesn't actually go down. In terms of what you were mentioning, and like, we're still seeing new layer ones come out that are claiming to even be more scalable or do more transactions than Solana. This is like the Aptos, Sui, Say. This is like the newer, kind of brand of like high throughput blockchains. And I don't think there's like a step change innovation with any of those. I think it's kind of similar to what Solana has. And it's just, VCs are throwing money at those. And so there's an incentive to go build them. And we'll see. I'm sort of thinking that it's probably like these two. And we'll see if those other blockchains get developers and users. But yeah, anything to add? I got a few more points to make just in terms of what this all means for developers, users, and kind of moving forward. Also value accrual.
Yeah. Before you do that, the quick question that I have for you is that when I look at the token economics row, I see EIP 1559 for Ethereum, which a lot of people would know. And in Solana, you said no EIP 1559. Can you tell me the significance of EIP 1559? And, since you mentioned no EIP 1559, are there other blockchains out there that are actually incorporating the Ethereum token economics on their layer one?
Yeah. So yeah, good question. And this is, I think, in some ways, like Solana launched its mainnet in March of 2020, like right before COVID. So important to realize they're, 5 years or so behind Ethereum. Ethereum's been around much longer, and they implemented, EIP stands for Ethereum Improvement Proposal. And this was a improvement to the fee structure with the token. And this was implemented in August of 2021. And what it did was it changed the monetary policy, where when you make a transaction on Ethereum, about 80% of your transaction fee gets burned, which acts as a stock buyback. I think that is the way that people should think about that. That is, you're taking that circulating token out of supply, and the remaining 20% is then paid to the validator. So that's how you're incentivizing the validators. There's also network inflation that gets paid to the validator, but that is typically offset by the burn amount. So you're not getting an actual increase in the circulating supply. The token economics for Ethereum was deflationary last year with those token economics, even during a crypto winter year. Solana does not have this. I think they are going to probably implement something like this. I think this has become somewhat of a standard. Avalanche adopted this. EIP 1559 Filecoin has as well. I think there's been a few others. Solana, the way Solana works today is if you make a transaction, they burn 50% of the fee. So not 80% like Ethereum. And that's not fixed for Ethereum. It's based on a few factors. So it's 50% is burned, and then 50% accrues to the validators. And because Solana is much earlier in its maturity, there's significant inflation. I think it's somewhere around 6% currently. So if you hold the Solana token, it's much more important to think about staking with Solana, because you're being diluted in ways that you're not by holding Ethereum. The network has inflation of about 6%. And then if you're a staker, you're capturing that. And if you're not, you're being diluted by it.
That's an important insight.
Think about that. Yeah. And you got to factor in that there's risk to staking. If you're using a liquid staking, I use Marinade Finance, but I don't stake, just a smaller portion of the portfolio, just because I view there is risk there. There is smart contract risk there to consider.
So before we proceed, that's what Michael does, and he's just sharing an opinion. And if you would have noticed at the start of our pre-intro segment for the rundown episode, this is not financial advice. It's just Michael's opinion there. But yeah, Michael, what's the takeaway? Because this is an amazing comparative qualitative and quantitative analysis that you've done through the DeFi report. What's the takeaway for the viewers?
Yeah, I think the big takeaway is, I think what you'll hear is people complain about Ethereum's modular tech stack right now and complexity with the user experience. So if anyone who has, used Ethereum and used L2s, this is not a good user experience. You have to, you're using your MetaMask wallet and you have to connect to other layer 2s and then bridge your assets to those layer 2s potentially to make a transaction, or your transaction could get lost or are not executed. Because of this modular tech stack, we haven't really gotten to the point where we've abstracted away all this complexity, right? Users should not have a drop down and you're picking which protocol to put it to. It's like imagine if users were picking whether or not to like interact with like HTTP versus like another protocol, like in the early internet days. Like this is not going to persist. So what we're waiting on is like this sort of abstracting away these complexities with the user experience so that the user doesn't even have to pick what layer 2 they're working on or whatever. It's just automatically happening underneath. So that is one thing. If you use Solana, if you set up a Solana wallet, interact with the blockchain, you'll be like, whoa, like this feels like I'm driving a Ferrari or something, because there's no bridging. It's very quick. It's very snappy. Transactions happen really fast. There's very low fees. So the UX is definitely better on Solana. If you're a user, one thing I'm trying to sort of forecast out here is, the next wave of users that come into crypto are going to be non-crypto natives, right? And so is it possible that because it's so much easier to spin up a wallet and interact with Solana, that's going to be the sort of the place where most new users come into crypto? It's possible that this happens. And then, what does that mean? And then does that mean that developers start to see that and they say, oh, I'm going to go build on Solana instead of an Ethereum L2? We'll see. I think Ethereum has really strong like network effects. But it still remains to be seen. If we're still very early, right, in terms of the number of developers, number of users. So that's something I'm watching for, is just how does that impact user preferences and where developers build? And then, is Solana actually going to end up as a modular tech stack? I actually think it is. I don't think that what they have currently is going to persist and be enough scalability. So you're already seeing like layer 2s. There's something called Eclipse. That's a layer 2 SVM Solana virtual machine already on Solana. Anecdotally, I was talking to some people at Token Terminal who I guess had spoken with Jupiter, which is one of the popular DeFi apps in Solana, and they were saying that they already needed a layer 2 on Solana. So that's the other thing, is like this is going to change. Like everything in crypto and these are open, permissionless ecosystems is evolving and changing. So I sort of expect that Solana may end up in a modular stack in the future anyways. So
that's amazing. Good takeaways.
Yeah, just coming back to the tech stack, when you think about value accrual, if you're a validator on Ethereum, right now you're capturing 20% of the transaction fee, right? And then plus the token incentives. If you're a validator on Solana, you're capturing 50% of the transaction. So just, that's enough. And then because there's different layers here, the transaction, less of that value actually hits the Ethereum validator, even though the fees are much higher. So the fees are much higher. So they're actually getting more value. But in terms of percentages, it's lower on Ethereum because you're bifurcating the economics with these various layers. So that's another thing to keep in mind, just with like value accrual between the two networks.
Amazing. Well, this was a power packed. You got a great one pager of comparative analytics, but we covered so many things, both academic and both quantitative as well. So I think for a lot of people who always had the question on how to compare between Ethereum and Solana, which one to pick from not only a developer point of view, but also from an investment point of view, I think this was a very useful exercise. So thanks a lot, Michael, for doing it. Is it time to go on chain?
I think it's time to go on chain.
Okay, so we'll go on chain with Token Terminal then, is it, Mike?
I'll see you in the terminal. All right, so we are in the terminal. It's time to just do a quick going on chain segment for this week. And I wanted just to highlight a new feature in Token Terminal. This is blockchain comparison. I've been using this. I find it to be just a really nice, clean, robust data set to do like pretty high level analysis across pretty much almost everything you need kind of in one view. I haven't seen any other data provider kind of put this out there, but you've got all the blockchains, right? So they've got 15 blockchains loaded up right now, many more coming. And then you can compare all of these blockchains across basically all the key metrics you would want to look at. So the active users, transaction counts, core developers, revenues. We've got some DeFi metrics in here, and then we've got total projects that are building that are loaded up in Token Terminal to compare against. And like one way, this is just a nice way to like come in, see what's happening from a high level, and then see if there's something catching your eye in terms of like the trends. I like to look at like either the 30-day trends or 90-day trends to see if something's jumping out. And I've been noticing like, Ronin here, you can see that it's had like a 1,600% increase in active users like over the last 90 days. If you're an analyst, that might catch your eye. And then you would think to yourself, like, okay, how do I sort of dig deeper on that and determine, is there like one project within Ronin that's driving that? Ronin is a side chain of Ethereum that is focused on gaming. This is the chain that had Axie Infinity. People will probably remember was a popular game. It didn't really work out. Maybe we'll see it come back, or if they made changes to it. Didn't work out, but got a lot of users, and I think people are going to iterate on that concept. But it looks like something else is going on Ronin now. So one way to sort of explore this a little bit further would be to drill down on it and go into the trending contracts. And so from this view, we can look at Ronin only, and we're looking at all the different contracts that are related to the Ronin blockchain. And when I say contracts, like I'm kind of referring to, I consider these business units essentially, because smart contracts, they have users that are interacting with them. So they have unique user wallets that interact with these things. People deposit funds and assets into smart contracts. In some cases, the smart contract is creating a two-sided marketplace. So you have, buyers or sellers interacting with the smart contract. So these things have economics. They function as business units, essentially. So we're looking at all the various business units here on Ronin, and I'm looking for like something to jump out to say, what's driving that big increase in users? And it looks like it's like this pixels game tracker. And so this is just a way, again, we went high level, now we're down at the contract level. And this would be a way for an analyst to like look into that and say, what's pixels? Should this be on our radar? Does it have a token? So you could kind of look into this. This is the Pixels website. It's like a pixelated art game, something like that. I haven't used it, but this would be one way to like, now you have to kind of go play with the game and figure out if the game is actually interesting. Like what's the token economics that we would go through, like who built it, who's behind this, do a full breakdown of the team and the token economics and the business model and the early adoption, the users and all the on-chain data to determine if, it made sense. And you could go to DApp Radar. This has a little bit of information on just the project itself. Pretty interesting to see the volumes of trading volumes. I had 1.1 million in trading volume just a couple of days ago. Maybe an outlier, who knows? One thing I was asking myself when I saw those active user numbers that were so high was, does this thing have an airdrop or something? Like most crypto projects will use a token to incentivize the early users, as we know, and we've talked about on this show. So I Googled Pixels, airdrop, and of course there is an airdrop going on currently, and they probably announced it a few months ago, and that's probably why those active users. So people will sort of farm for these airdrops. They'll go and interact with the smart contracts to basically make themselves eligible to get that airdrop. And so, how do we figure out, are those real users? Are they mercenary users? Are they going to be there for the long run because it's a fun game to play? That's where this cohort analysis comes in for, Token Terminal. Again, this is a great feature to sort of really drill down and assess, how good a project or a blockchain is at not only onboarding users, but then retaining them over time. So the user keeps coming back, interacting with those smart contracts. If you wanted to assess the impact of an airdrop or an airdrop an announcement, this would be a way to do that. We don't have the Pixels project in here just yet, but if it becomes a bigger game, I'm sure it'll get loaded up into the system. I've just got Ronin pulled up here. I just want to sort of share like a way to do like high level and then just go down a few other steps to go a little bit deeper for people out there that are just kind of looking for something interesting as they're doing their analysis, as they're doing their research, and using on-chain data as like the leading indicator to do that.
Amazing, Michael.
Rather than going to crypto Twitter, right, and having some influencer just telling you to do something, and then you go buy the token, and you have no idea what's behind it. So
yeah, a lot of crypto YouTubers doing unboxing of Pokemon sort of cards and then shilling their own NFTs which eventually dropped by 99.9%. No points for guessing who I'm referring to. But anyways, quickly, Michael, I loved what you showed me regarding that business unit comparison. If you don't mind going to that particular section again, amazing. So, when I was seeing this, I noticed that there are certain contracts, because that's the terminology being used in Token Terminal, that are unlabeled. So a lot of people would be like, asking, what does this unlabeled mean? Before I put that question to you, I just want to say out, there is a reason that we partnered up with Token Terminal, wasn't it, Michael? Like, they are really the premier when it comes to providing on-chain blockchain data. The amount of hard work that goes in the background by the employees of Token Terminal to collate all this blockchain information, label it, so that people who've got access to the pro account or even the normal account of Token Terminal can go there and do this amazing analysis by just having a login to Token Terminal is just so valuable. And, my commendation to the entire Token Terminal team for providing such useful analysis in such an easy, accessible, and visualized manner that we can just go, when we see Ronin having a lot of activity, we can just go see the trending contracts within a particular blockchain, even, not as popular a blockchain like Ronin, and can easily decipher, okay, it is this decentralized application that is doing amazing work. And then we do further drilling down of it. So I think amazing work by Token Terminal that I'm not applauding because they are our data providers, but because they deserve it.
I would agree. And I think what I like about Token Terminal in particular is that it's a full stack provider. And I think this is one of the reasons they've become sort of the main provider for institutions, and they're integrated with Bloomberg, is because of the fact that they run all these nodes. They then, push all the data into a data warehouse. They have a team of people that are structuring the data, doing SQL, standardizing the data, and then visualizing it through their dashboards. But yeah, this is a challenge. You mentioned these unlabeled contracts. This is a challenge for any data science project out there, really, is, how do you make the data human readable? And so you have all of these contracts, they're loading up these nodes and running these nodes, and then looking at all of these contracts, which are the teams are the ones that typically will label these, and then they're essentially checking that to make sure it's accurate. I think this is sort of a chance to do a public service announcement for all these teams out there that are building on blockchains to label your contracts. Please, label your contracts, make your stuff transparent and human readable so that the market can interpret what's going on in your blockchain. You want the market to know what's going on in your blockchain. So you don't want it to be hidden. So yeah, these are just some that, we just don't have labels on them. They're small contracts right now that we just don't have the labels on them just yet.
Yeah, you just couldn't have said it better. We want more transparency among the blockchains so that the industry can have more financialization products through it, more developer activity. So you couldn't have said it better.
If you're a project out there, the way I think this is going is the market is going to be looking at investing in things that they understand. And so if you are not labeling your contracts, you're not listing with Token Terminal, you're not open to audits and the market really digging in on your project, then I wouldn't expect that there's going to be a lot of investment in those types of projects. And so I do think that as the industry matures, you're going to have to get listed with somebody like Token Terminal to be able to get to that level where the market respects what's going on, and because they can see behind and they can assess the adoption, the usage, look at KPIs and metrics. If they can't do that, it's really hard to invest. So I think that's something to keep in mind.
So Michael, just quickly, because I know I get a lot of requests on LinkedIn by people saying, how do we list our blockchain or project on Token Terminal? What's the process? Are you aware of what's the process on listing to Token Terminal?
Yeah, there is a listing form on their website. So people, you can just go to the website and fill out the listing form. We can put a link to that form in the show notes if anyone's looking for that link. But yeah, there's a form to fill out. They work with these teams to really streamline this process where all these contracts can be labeled up. They have all kinds of templates and forms to do this in a pretty streamlined way now. But yeah, there's a form on the website, and I know they're super busy. There's constant work to get these added up. I know they're trying to get to 100 blockchains in here this year. So a lot going on behind the scenes.
Amazing. Look, we've been speaking for 70 minutes. and it didn't feel like it as well. This was a great show. What do you think, Michael?
Great show. Looking forward to next week as well. I think we packed a lot in to this one with just covering Bitcoin ETF and some of those flows. Hopefully we provided like a somewhat non-technical overview of Ethereum versus Solana. We can certainly go into the data on that as well. I think it's more helpful at this stage to just kind of look at it from just kind of the architecture and the different approach to scalability. And hopefully this is helpful for people to see how you can use on-chain data to do kind of high-level analysis and then just kind of keep going deeper. We've got, future episodes. We do have a guest coming. I won't announce it just yet, but we've got someone exciting in the next couple of weeks. And yeah, people should let us know if there's topics they want to see us cover moving forward. We're happy to bring the audience to what they want.
So I do not know, I know that people were Michael Nadeau fans on LinkedIn and people were DeFi Report fans as well. Somewhat similar for me, there were a lot of people who were fans of me as university professor and a proof of work podcast person. But I've been getting a lot of LinkedIn inbound requests that they love us on the Rundown. Are you getting somewhat similar? That Michael Nadeau fans of Rundown?
I'm getting more people that are noticing the content through this video format, which is great. So it's a new way for people to discover our work. I'm excited about this video stuff. I don't know if you've noticed, I've been doing a little bit more short form video stuff just through LinkedIn and Twitter as well. So yeah, excited to just do more with video. I think, I put a poll out actually to the readers of the DeFi Report recently, and they're used to reading the analysis. And I think they still prefer the written reports, but it was nice to see that there are plenty of people that would love to see both. So it's helpful to get the written reports and then also have it in this like video format, maybe a little bit easier for some to consume. So yeah, excited to keep going.
So the reason why I asked is that I've got a lot of requests that we should do a Rundown Summit in November to mark 1 year anniversary of the Rundown. So we should talk about it considering now we are starting the Q2 of the Rundown. But we'll do it off the record. Any last words for our viewers, Michael?
I think that's it. We'll see everybody next week.
Amazing. Thanks a lot, everyone, for tuning in. Please let us know the feedback, like, subscribe, and yeah, see you guys next week then.
Thanks, everybody.